Now, with the deregulation in the 90s and 2000s, the limits that were actually always imposed to speculators were dropped, and that's why you've seen a huge increase in the speculators in this market. But importantly to remember is that for the last 10 years, pension funds and institutional investors have been explained by banks that this is something they can invest in. We just completely not agree. This will never be an investment vehicle, and that's why we think no money should be flowing in these markets from non-physical hedgers, except for the small speculators proportion. So something very important to understand as well is that the situation we hear now is very recent in a way that until 2000 you had position limits. Okay, so it's position limits on speculative positions are as old as these markets, just because commodities have always been seen as crucial to society, because basically it's energy and food, and with energy we heat ourselves, we commute, and food, obviously we need food. So from the start there were limits because it's obvious that too much speculation disrupts the price formation mechanism and takes it away from the fundamentals. So it's only very recent that we've taken these position limits out, and that's why the debate here is just about going back to common sense. And in fact, 10 years ago, so in 2000 in the US, we had a major deregulation act on commodities futures. And it's just going back to that, saying, well, that was a mistake, because we'll look at the graphs in a moment. If you like, you will see that as from the moment we deregulated these markets, speculation again boomed. And if you look at the price of the physical commodities in parallel, you will see that not only do they rise, but more importantly, the volatility goes really high. So again, position limits are just a common sense tool that have been attached to commodity derivatives from the very beginning of these markets. So it's not some new radical measure that the industry could not bear with or anything. Yes, they had huge investment and profit opportunities for the last 10 years thanks to deregulation, and sure, they want to protect that. That's it's their role. I wouldn't expect them to do otherwise. Well, I mean, again, the mindset for the last 20 or 30 years was that if you unleash the abilities of the financial markets to innovate and do basically what they want, to make it very simple, it could only benefit the whole of society, because they would create new products, more limit the risks, increase the profits, and so on. So there would be an automatic link between unleashing their ability to innovate and benefits for society. So that was the mindset at that time, and we've seen that it's the result is not as we hoped for in terms of risk management, for example. They could take huge risks, and then, as we saw with the crisis, it's society who's going to pay for those risks when everything collapses. We saw that in 2008. So removing position limits was just one item among many others, which was aimed at increasing the efficiency of the industry. So increasing its freedom, if you like, with the assumption that it would benefit society as a whole, which of course is not the case. We should go back to a situation that we had for 40 years, where it was clear for everyone that you need a balance of powers, and that you cannot just leave private actors completely free to do what they want.